Greetings, welcome to Presenter Comments Tutorials. In today's tutorial, we'll approach a practice question on IAS 2. Given that Okahanja Candy CC is a confectionery that manufactures various sweets and candy from syrup. Syrup is the raw materials used in the manufacturing and is purchased in kilograms. No wastage of syrup occurs in the production process. Thus, 1 kg of syrup material is required to produce 1 kg of finished goods. At each financial year end, no work in progress is on hand. The cost of finished goods is calculated based on weight. The following information is available for 2020 financial year. We're given opening inventory on 1 January 2020. Raw materials containing of 150 kg of syrup, 7,500. Finished goods, 250 kg, 30,000. Syrup purchases on 1 March 2020, the entity purchased 950 kg at $60 per kg. That is 57,000. 1 September 2020, they purchased 1,000 kg at $65 per kg, and that is 65,000. Salaries and wages, direct labor, 90,000. Production management, 30,000. Administration and sales personnel, 20,000. Color and flavorings used in production process, 7,000. Water and electricity relating to the plant, and in brackets, variable, 4,950. Advertising and other marketing costs, 15,000. Depreciation for plant is 15,000. Office equipment, 5,000. Repairs and maintenance relating the plant, 50% of it is fixed, which means 50% is also variable. Additional information. On 31st December 2020, 300 kg of raw material and 350 kg of finished goods were on hand. Normal production capacity is 2,000 kg of finished goods per year. Adjustment 3, due to an increase in the consumer's health awareness, the market share for sweets and candy has been declining. As a result, management is forced to reduce the future selling price to 160 Namibian dollar per kg, and the selling costs are expected to be 9 Namibian dollar per kg. Segment 4, inventory is valued on the first in, first out basis, and are told to ignore tax implications. Required, disclose the above transactions in the notes to financial statements. Accounting policies are required. Before we approach this question, I would like to emphasize on the disclosure requirement as per IAS 2. The disclosure requirement of IAS 2 for the statement of financial position, statement of profit or loss, and other comprehensive income and notes are as follow. For the statement of financial position, we disclose the total carrying amount of inventories. In the statement of profit or loss and other comprehensive income, we disclose the amount of inventories recognized as an expense during the year. That's where now we have cost of sales, which includes the cost of inventory sold, the unallocated production overheads, abnormal wastage, write-downs of inventories, as well as reversals of inventories. Now, in the notes to the financial statements, importantly, we disclose the accounting policies adapted in measuring inventories. This then includes the cost formula used, and also disclose the amount of any write-downs of inventories recognized as an expense. We also disclose the circumstances or events that led to reversal of a previous write-down of inventories. We also disclose the amount of any reversal of a previous write-down recognized as a reduction in the amount of cost of sales. Okay. Now, back to our question. We are required to disclose above transactions in the notes to the financial statements. Accounting policies are required. That means we should prepare notes to the financial statements. The accounting policy should also be disclosed in the inventories, and profit before tax notes should be as well disclosed in. Okay. So what we do then first is to show our workings. Our workings will help us get the closing values for these inventories: raw material, work in progress, and the finished goods. So start with the raw materials account. Remember, these accounts are inventory accounts, they are assets. They do increase on the debit side. Now with the raw materials account, on the debit side, you write opening balance or balance brought down, then the number of units, and the amount, which is 7,500. And you write a purchased, or if you wish, you can write bank. If the inventory was purchased via EFT, you write bank. If it's from a creditor or it was purchased credit, then you write creditors. The total amount is 122,000. Okay. If you look at our question here, the opening inventory amount is this one, 7,500 for raw materials. And the purchases during the year, on 1 March, this inventory came in and the amount is 57,000. And 1 Sep, this inventory came in and the amount is 65,000. So the total then gives us 122,000. And if we add these cages to give us 1,950. Okay, that's how we now got these values here. After that, we go to the closing balance. You can write balance carried down. Now, if you look at adjustment, 1, we are told that on 31st December 2020, 30 kg of raw material were on hand. That means raw material or closing balance for raw material content of 300 kg. So what you then have to do is take the 300 and then multiply it by $65. Okay. how did you then get the $65? Or why are we multiplying by $65? So if we look at adjustment 4, we're being told that inventory is valued on the first in, first out basis. Okay. So have to bear that in mind. And if you look at the information given, inventory, raw materials, the raw material that were in the business at the beginning of the period contained of 150 kg. And during the year on 1st March 2020, the business purchased 950 kg. And on 1 Sep, the business purchased 1,000 kg. And at the end of the period, the business only had 300 kg of raw materials at hand. Okay, so to get the closing value for the raw materials, since we're using the first in, first out method, it will then mean that this inventory or these raw materials of 150 kg were all used up. And then the next raw materials that came in the business, these ones here, they were all used up. And the last raw materials that came in the business contained of 1,000 kg. So it will mean that they were all not used up. Instead, the business only used up 700. They only used up 700 kg. Okay, then 300 kg were on hand. Therefore, to get the closing balance for the raw materials, we take the 300 kg and multiply it by 65. Okay, simply because this 1,000 kg of syrup or raw materials came in at $65 per kg. Therefore, the remaining kg are resulting from this 1,000. So we take the remaining kg and multiply by $65. So having done that, we'll find out that our closing balance for inventories is 19,500. Okay, now to know the value of the amount of raw materials transferred to work in progress, then have to take the total minus this, or in other words, the balancing figure will then be the amount of raw materials transferred to work in progress. Okay. And the other thing again, if you look at our question, you'll notice that on this day here, we had 150, they're all put in production, and 950, they're all put in production, but here only 300 kg remain, which means that only 700 were put into production. Therefore, the total number of kg that were put into production for raw materials is 150 plus 950 plus 700. And that gives us 1,800. So 1,800 kg were put into production. Okay, and the amount is this one, the balancing figure. Okay, now once we're done with our raw material account, have to come to work in progress. If there's any opening balance for work in progress, you write it. But in this case, we do not have opening balance for work in progress. Raw material, so we have to transfer now from the raw material account to work in progress. On the debit side, we record that amount, which is 110,000. Okay, so this is our raw material account, direct raw material. Okay, so we have direct labor. We have direct labor 90,000, coloring 7,000, electricity 4,950. Okay, so direct labor is given here straight, just take it the way it is. And Color and flavorings given 7,000. Electricity and water, we're told that these ones are variable. So we just have to take it like that. So you can notice that this one and this are variable manufacturing overheads. Now, as per IS2, if it's variable overhead or manufacturing overhead, we just have to allocate it the actual production the way they are. So that is actually what happened. We just took the 7,000 and the 4.950 and we allocated to production, to work in progress. Okay. Now this cost doesn't fall here. So this one, we leave it out. We come to depreciation. So depreciation on plant only, the depreciation that we have to take. And this one is for office equipment. Therefore, we don't include it in work in progress. So only have to take the depreciation relating to the factory, which is this one here. And that depreciation is 15. Okay, so that depreciation is 15,000. But since it's a fixed manufacturing overhead, we don't have to take it straight forward to the work in progress. Okay, we'll come back to that later. We go to repairs and maintenance, planned 50% fixed, which means 50% is variable. So the total amount is 9,000. Now coming to work in progress, what we have to do is that we take the 9,000 and multiply it. 9,000, we multiply it by 50%. So 9,000, we multiply it by 50%. It will give us repairs and maintenance that are variable of 4,500 Namibian dollars. Okay. The other thing again, if we look at this question, we have fixed manufacturing overheads. Fixed manufacturing overheads like the depreciation for plant, that is a fixed manufacturing overhead. It doesn't vary with the production volume. And the other thing again, we have that 50% of the repairs and maintenance are fixed. And we have salaries and wages relating to production management. That's where now we have the salaries of the supervisors. The salaries of the supervisors are not regarded as fixed, are regarded as fixed manufacturing overheads. Now, what you have to do, since the fixed manufacturing overhead amount is not given straightforward under these balances, what you then have to do is that we take all the items that fall under the fixed manufacturing overhead, we add them, and after adding, we have to allocate to inventory or to production as the IS2. Now, the first fixed manufacturing overheads is production management. That is the salaries now for the supervisors, etc., etc. So the total amount is 30,000, and for depreciation is 15,000. For repairs and maintenance, 50% of the 9,000 is 4.5. So we open an account for fixed manufacturing overheads. On the debit, if there's any balance brought down or opening balance, code it. But in this question, we do not have, neither know the closing balance. So salaries that we mentioned is 30,000. Repairs and maintenance, half of the 9,000 is 4.5. Depreciation is 15,000. So the total then is 49,500. Okay, 49,500 is the total amount for fixed manufacturing overheads. As per IS2, we now have to allocate these fixed manufacturing overheads to inventory, which is work in progress. How do we then allocate this to work in progress? Okay, if you look at additional information, we are told that the production or the normal production capacity is 2,000 kg of finished goods per cage. Okay, we're told the normal production capacity is 2,000 kg of finished goods. Now, if we look at our first ledger accounts, the cage of raw materials that were transferred to production or to work in progress is 1,800 kg. And also, if you look at the very first information given, you'll notice that 1 kg of syrup material is required to produce 1 kg of finished goods. Now, what does it mean? So it means that since 1,800 kg of syrup material were transferred to work in progress, and again, we are told that at year end, no work in progress is on hand, which means that the entire amount of 1.8 kg that were transferred to work in progress were all produced out. So this amount was all produced. Okay. Now, if this number of kg were all produced, how many kg of finished goods came out? It means 1.8 kg of finished goods were produced. Okay. How? Simply because 1 kg of syrup material produces 1 kg of finished goods. And again, 1.8 finished goods, 1.8 raw materials were transferred to work in progress, and there was no closing balance for work in progress, which simply means all of the 1.8 kg were put into production and they were produced out. In other words, they were completely converted to finished goods. Okay. Now back to adjustment 2. Since the normal production capacity is 2,000, but the entity in this case only managed to produce 1.8 kg, therefore there was low productivity. Now, as per IS2, if there is low productivity, what we have to do to allocate our fixed manufacturing overheads is that we need to take the total manufacturing, fixed manufacturing overheads, and we divide it by the normal production capacity. In this case is 2,000 kg. So 49,500 over 2,000, that is 24.75. And after that, you take that amount and multiply it by the actual production. So the actual production is 1.8. So the amount we're gonna get then, which is 44,550, we transfer it to work in progress. Now, IS2 still guiding us that the difference between the amount of finished manufacturing overheads transferred to work in progress and the total The difference then you have to expense it to cost of sales. So what you have to do then is you can write cost of sales, so details, or you can write fixed manufacturing overheads underproduced. So the difference then in this case is 4,950, and that is the amount we expense cost of sales. Okay. Now, this amount coming to the work in progress account, we write fixed manufacturing overheads, 44,550. Then you add everything, get your total, and then you transfer to finished goods account. Why are we transferring the entire amount? Simply because we are told that no work in progress was on hand at year end. Okay. So coming to the finished goods account. So it's also an inventory account. Remember that? Increases on the debit side, which means the opening balance should be on the debit side. Opening balance is given under the balances, 250 units, and the amount is 30,000. So how much is being transferred from work in progress? So from work in progress, this amount. So it's coming in from work in progress, 261,000. Get your total amount, and after that, you go to closing balance. Now, with the closing balance, the first adjustment, we are told that 350 kg of raw materials, of finished goods, were on hand. So you take the 350 kg or units, and the question is, how do you then get the value for this closing inventory? So what you have to do, if you look at what we're told in our question, we're told that the cost of finished goods is calculated based on weight. The cost of finished goods is calculated based on weight. Okay, that is weighted average. So the cost formula there is the weighted average method. So what we then have to do is to get the average cost for this inventory that came in. We need to get the average cost for this inventory that came in. So we take the total amount for that inventory. Take the total amount for the inventory, and we divide it by the total number of kg. So the answer we're gonna get then is the average cost for that inventory that came in. Remember this inventory that was transferred from work in progress, the actual value was 261,000, and the total number of units, since all the units were produced out, then that is 1.8. To get the average cost, we take this amount and divide it by the number of kg, get 145 Namibian dollars, and then multiply it by 350 units. So the amount we get then is a closing balance for finished goods, which is 50,750. The difference is what we transfer to cost of sales, and that is 240,250. Okay. So number of units that we transferred to cost of sales, or number of units sold out. In this case, if we look at the inventory that the finished goods that were in the business. Finished goods inventory, 250 units, and 1.8 came in. That is already like 1.8 plus 250. So there were like 2,050 kg of finished goods in the business. But at the end of the period, the business closed with 350 kg. That simply means 1.7 kg were sold out. Okay. And the other thing, we now have to check if there's any write-down of inventory. So you have to check if there's any write-down of inventory. We have to compare the net realizable value with the cost, which is 145. So the net realizable value, can say adjustment 3. We're told that as a result, management is forced to reduce the future selling price to 160 per kg, and the selling cost expected to be 9. So to get our net realizable value, just take the selling price, which is 160, then minus the selling cost. Our net realizable value will then be 151 per kg, and we compare it with the cost per kg, which is 145. You clearly tell that the net realizable value is more than the cost of 145 per kg. And as per IS2, we only have to write down inventory if the net realizable value is more than, is lower than the costs. Since in this case now it's more than the cost, therefore there's no write down of inventories. Now, after doing the workings, we now go back and answer the question correctly. So since this question is asking about the notes to the financial statement in accordance with IS2, so study the accounting policy as required, write accounting policies, and say inventories are measured at the lower of cost and net realizable value using the following valuation methods or cost formulas. Raw materials and work in progress, in this case, we're told that by using first in, first out method. Finished goods by using the weighted average method. I will come to profit before tax note. With the profit before tax note, write that profit before taxation is stated after taking into account the following. Write cost of sales and say cost of goods sold. That amount we're getting from the finished goods account, which is this one, 200, not this one, please. But yes, this one, 240,000, 250. You write it here. And if there's any write down of inventories, you write it, but in this case, you do not have. And fixed production overheads under recovery, we write 4,950. Okay. So this amount is resulting from the unallocated fixed manufacturing overheads. Remember, as per IS2, the unallocated fixed manufacturing overheads should be expensed to cost of sales. So we add then all this should give us this amount. We add everything here, should give us this amount. And note number 3, that is the inventory note now. Raw materials, you write the amount, that is the closing balance for raw material. Remember, as per IS2, raw materials should be shown at their carrying amounts. In other words, they should be shown at their closing balances. So for work in progress, we don't have finished goods 50,750. Okay, this amount, and finished goods is the amount. Okay. So if you look at this question, this is what we actually asked. This notes, that is what we asked. Sometimes you can only be asked the inventory notes, but now the foremost thing is that you must first start with your workings. Okay. In order for us to get this amount, we needed these workings. In order for us to get the finished goods amount, we needed this working. So it means without the workings, then it won't be possible to record properly or to write correct amounts in the notes. Okay, so our workings are so important. Sometimes you might only be asked the inventory notes, and that will actually require you to do your workings or to show your workings. And I will encourage you to use the ledger accounts. The ledger accounts are so easy. Just have to look at the movement of inventory. Okay, just have to look at the movement of inventory from raw material to go to work in progress, from work in progress to finished goods. Okay, then the closing balances should be what you record here. All right, then this brings us to the end of our tutorial and end of IS2. Don't forget to subscribe, like, share, and comment. See you in the next video. Bye-bye.